The following program is sponsored by MaxOut Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, MaxOut Savings Advisors, or its sponsors. MaxOut Savings Advisors and members of the MaxOut Savings team may or may not hold securities mentioned during the show. Plan for your prosperity. Prepare for your retirement. Safeguard your savings. And nurture your investments. This is the MaxOut Savings Show with Ted Geoca, a presentation of MaxOut Savings Advisors. Now, here's your host from MaxOut Savings Advisors, Ted Geoca.
Morning and welcome to the MaxOut Savings Show. I'm Ted Geoca, and we're talking savings investments in your retirement here on the MaxOut Savings Show. Our show is all about building up wealth, understanding the world today, and understanding where we're going, dealing with retirement, and dealing with building up your savings to retirement. How do you deal in these very unstable world? And so we're going to be talking a lot about that on the show today. Our motto and our philosophy is to save aggressively and invest conservatively. Save aggressively, invest conservatively. That's the key to building up wealth over the long term. Starts out with your 401k plan, your qualified plans. Put away as much money as you can. Our goal is a minimum of 10% for everybody, plus the company match gets you to be about 13%. This is super important. This is how you build up wealth. You put in, let's say you put in $10,000. You get a $10,000 tax deduction right away. You get growth, tax-free growth for the next 20, 25, 30 years, however long you were. Actually, longer than that throughout your life with the money. It's a phenomenal deal. This is what Warren Buffett only dreamed about and did everything he could to try to replicate. But he didn't get the good deal that you got, that you also get the tax deduction. And so take advantage of it. If you're over 50, if you're behind in retirement, and a lot of people are, now's the time to take charge of your retirement to build that up. At MaxOut Savings Advisors, we manage retirement wealth. People retire, they have an old 401k plan, they come to us to manage it. We don't manage 401ks, but this is so important that we always like to talk about it starting the show because we want you to build up wealth and have a happy, successful retirement as well. So remember, save aggressively, invest conservatively. Wow, we've got a lot to talk about. I mean, it never ends. We started this show 20 years ago talking about savings and savings was at record lows. We got to increase your savings. And recently it was at 26%, which is not a good number. So we would talk about retirement plans, all types of different things. But now the world moves so quickly that it's truly extraordinary. And every week it's a new thing. I mean, we have a lot of things to talk about this week. Market hit new highs. I mean, things are going fantastic, up record highs on Tuesday, and then basically the whole thing blew up Friday. We had some good numbers come out on the jobs, 172,000 jobs, and they were expecting 85,000, which is good news. But the talk has really been, interest rates are coming down, everything is in good shape. But inflation has been there, and so the 10-year bond jumped up to 4.5%, over 4.5%. The long bond moved up to 4.99%, which is obviously it went over 5. They wanted to get it down under 5 by the end of the day, but rates are clearly going up on the long end and even on the shorter end because people fear inflation. The most recent which one is it? The most recent inflation numbers, the CPI, PPI were rising. On some of the other numbers, we came in at 3.8%. And again, this is not 2% inflation, and so it's difficult to cut rates. Rising rates aren't good for the markets. And so the market started selling off of that news. But there's some other really big things happening out there. And this is really the question we got to ask ourselves, is some type of top been put in the market? And we're going to discuss that today. We put a hedge on for our portfolios Friday morning. And just because we really, and I kind of debated about it the day before, and it just what we're really seeing is a very, very hot, very frothy market. Stocks are skyrocketing up, 10, 15, 10, 20, actually 30% a day. And these aren't small, they're not small, high flying tech stocks. And these are some of the largest companies in the United States of America. And that's a very unstable market. And so we want to cover that today in really what's going on. And I think as we've been talking, we send out one of the Max Out Savings Show. One of our things we put out is a free report called the MaxOut Savings Report, and we write about everything from what is the latest amount you can put away in your Roth IRA or your IRA for the new year, to tax saving ideas, to very complicated issues, and we've really worked very hard and do a lot of research to try to get you ahead of it and to put things into this report that are very useful. We back in November of 2007, we wrote about October, November. We wrote about how an investment bank was going to fail on Wall Street. We talked about it on the show at the time, and we didn't just say, hey, things were going to fail. We pointed out the balance sheet and explained exactly what the balance sheets were going to destabilize. We had a little growth chart on it, not a chart, but we had the balance sheets in the report, and a very simplified version of it so people could understand it. And we were correct. In January or early February of 2020, we're like, oh, hey, this is not looking good for COVID. I mean, we're writing about very cutting edge stuff, getting you ahead of where you need to be in these markets. So we send it out free. Just go to maxoutsavings.com. You're not going to get a phone call, an email from us. Maybe if we ever do a seminar or something, we might say, hey, we're having a sale, but it's a private list, which we do this as part of the show. So our most recent one, we made the comment: do not let this excitement, this froth on Wall Street, allow you to get carried away, to take on too much leverage, to be all in on the market. Have a risk plan in place to deal with it. And I think that's more important than ever today. It's looking at this market. It really, if you take a look at it on Friday, the S&P fell 2.6%, and the NASDAQ was down 4.2%. And just looking over, excuse me, let me just flip over here real quick. Looking over to the, bear with me, this is live on the radio. Going over to just looking at pulling up my list on the Bloomberg. These are stocks. The Planet Labs was down 25. There's the list got the top 21 stocks on and over $5 billion to get down to 10%. Here I'm flipping through this. Okay, there's 65 stocks on Friday went down 10%. 65 stocks on the list. And this is just the market cap in the United States of stocks over $5 billion. So it's not small stock, over $5 billion, and 65 stocks went down 10% or more. And so what we're dealing with, I mean, in some of these large stocks, Advanced Micro Devices, it's just SanDisk, a lot of the tech stocks, pretty much across the board. And this was kind of started the night before in Korea, where you have the Koreans are big makers of chips, and particularly memory chips, and it kind of fell apart over there, and then it came over here, and it's continued to kind of accelerate back down here. So it's clearly, we had a situation Tuesday where, hey, happy days are here again. The market was up huge. And right now, the market, the year to date, is up 7.6%. So it's still up some. The tech is a little more than, the NASDAQ is a little more than that. But But during this time, we've been saying in the last couple of weeks where we've had the market up hitting new highs, and the number of new lows keeps going up. If you look at the drug sector, if you look at the stable demand sector, you look at the food sector, if you look at lots of different home building, all types of sectors in the market we're selling off in here. And that's not a good sign that we're seeing in these markets. And so a couple thoughts in here. I think you really have to take a look at your retirement portfolio and kind of understand, hey, how much risk do I have in it? The S&P 500 is if you add up the top 10 stocks, which is, if you take your Mag 7, which is your Google, your Meta, your Amazon, your Apple, Tesla, NVIDIA, Microsoft, and then you add up Broadcom, Micron, Advanced Micro. It gets up to be about 40% of the average of the S&P 500. So basically, a lot of people have the vast majority of their retirement plans in an index in the S&P 500, and you're 40%. That's the top 10. That doesn't include, how many other, quasi tech stocks or tech stocks. That doesn't include a lot of other smaller stocks out there. It doesn't include computer makers. It doesn't include other chip makers. It doesn't include a lot of things. So that number is probably over 50%. And anyone that's studied the stock market knows that tech can be incredibly volatile. And so I really think it's important to take a look at your portfolio and understand where you are for retirement. So I really wanted to talk about that today, and see how much. What is your percentage of bonds? What is your percentage? What are you long-term bonds or short-term bonds? The 30-year went back up over 5%. Inflation is clearly there. The PCI number, PCE, personal consumption expenditure, was up 3.8%. Here recently, again, these are supposed to be closer to 2%. We have a new Fed chairman, Kevin Warsh. He's come in there now. Very, very bright guy, very talented, has big ideas. We're doing a lot of research to understand what he's trying to do. And there's some really fascinating and extremely complex things he wants to do. They're going to have consequences that we're kind of parsing through now. But his life has been made, quite frankly, much tougher by the Iran war, because we have oil prices have skyrocketed, pushing inflation up higher. President Trump wanted inflation, he wants the interest rates cut. Well, it's real hard to cut interest rates when oil's at $100 a barrel, and the price of everything is going up. And so this is something that we're dealing with. And one of the key things is if you study incoming Federal Reserve people, markets tend to test them within 3 months of when they get in there. And honestly, this is a really tough, he's got a tough job. His job's been made much tougher by high inflation, high oil prices, runaway AI spending, that $38 trillion deficit, a $2 trillion budget deficit. And the last thing we needed was the Iran war, causing more inflation. But here we are. So I want you to understand there's big changes happening, big changes coming. I'm going to discuss the one thing I think that maybe is really caused this drop and is going to likely cause some type of correction in here, or at least a top in the market, after this quick break right here on the MaxOut Savings Show.
The MaxOut Savings Show with Ted Geoca will return shortly. To speak with Ted Geoca now, call 713-339-1070. Back in a moment with the MaxOut Savings Show.
AM 1070, The Answer.
Hi, this is Ted Geoca of the MaxOut Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the MaxOut Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today and help you understand it and help you save money and build up wealth. It's the MaxOut Savings Show. And if you need some help, go to our website, MaxOutSavings.com. That's MaxOutSavings.com. On the website, you can sign up for the free MaxOut Savings Report. Our report covers all types of these big issues, the changes in the world, that helps you understand and protect your retirement. So go to the website, MaxOutSavings.com.
We return now to the MaxOut Savings Show. Here's Ted Geoca.
Welcome back to the MaxOut Savings Show. I'm Ted Geoca, and we're talking savings, investments, and your retirement. And so I'm trying to do two things at once. Some good information came in on my phone, so I'm all thrilled about that. I just had to check something out. By the way, if you have a question or comment, we think give us a call at 713-339-1070. We're now starting to do video here on the MaxOut Savings Show. There's been a lot of demand for it. We're going to expand the show some more. It's been very successful. It's one of Houston's most popular financial shows, so we're excited about that, and we're working through that. So a lot of great things are happening on the MaxOut Savings Show. Now then, what happened this week? What market hit a new high Tuesday? Things are going great. Happy days are here. I mean, the champagne is flowing on Wall Street. Several investors drowned. There was so much champagne on Wall Street, and all of a sudden, the market, the Nasdaq falls 4%. 65 stocks fell 10% in one day on Friday. What happened? And I tell you, it was a combination of a number of things, as we talked about, really rising interest rates, rising inflation, high oil prices. And I think people are starting to understand they're having trouble buying the deals about done in Iran over the weekend. We're this close, we're loading the jet to head over there. And then, the Iranians the next day go, no, there's nothing going on. And I think they're realizing this is a long-term war. But the big thing, and one of the things that really accelerated it on Friday was Meta. Meta came out and there was rumors, and they seemed to, there was an awful lot of smoke on this one, that they were looking to do a secondary. Now, Google did which is a secondary, is you're raising more money, so you're selling stock. Google did an $85 billion money raise about a week or so back. And you're kind of like, wait a minute, I thought things were going well. Everybody was making so much money. And all of a sudden they're raising $85 billion. Excuse me. And so what's happening here? And I think, because keep in mind, let me lay out the situation at the beginning of the year. We're going into AI. There's going to be lots of spending on AI. AI was going to be great. They were going to spend $400 billion on AI this year. And so we had all the companies, Microsoft, Google, Amazon, Apple, Meta, Oracle, NVIDIA, they were spending money. Things were going great. But they were also, with the exception of really NVIDIA, they were all buying back huge amounts of stock. Now, why were they doing that? Well, because Microsoft controls the operating system on computers. These companies are all monopolies, and so we're going to get to Charles in just a minute. These companies are all monopolies, right? So Microsoft controlled the operating system. Google controls search. Amazon controls internet shopping and also the cloud. Apple controls the phones for operating, and Meta controls Facebook and Instagram, collecting all your data and selling it to everyone. And that huge cash flow and everything is great. Well, all of a sudden AI has come in. They're all fighting for the same territory now. Before, they were sitting in moats with these castles with basically a money machine. And the biggest problem, they were having to expand the castle to put more gold into it because they were making so much money and they were buying back stock. That all has changed. They were going to spend $400 billion. Well, you know what the number is now? The number is about it's about 700 to 800 to $900 billion this year alone they're having to spend. So they're like, hey, no problem. We've got all this money, and they keep spending. Well, all of a sudden, Google has come out and said, well, we need $85 billion. Meta's coming out that they might take some money. Everybody is coming to the market. SpaceX is coming to the market. Anthropic, which was the big one, the big AI company, that one to come to the market. OpenAI wants to come to the market. Matter of fact, OpenAI wants to come to the market. Anthropic was going to be late this year. All of a sudden, they did a secretive a deal with the SEC, kind of a blind request for money, where the SEC is doing it, but they're not going to release information. So everybody's rushing to the door to raise money. There's another 1,000 companies raising money out that want to come public. Everybody wants to come public. So for the last 4 or 5 years, we've been sitting around doing nothing but growing earnings, buying back stock in these companies, so much so that they're probably getting 2 or 3, sometimes more % growth per year just because they're buying back that much stock. And so their earnings are going up. Even if they don't make another dime, the earnings go up 3% because they bought back stock. Well, that's all changed. Everybody is heading to the market. Look, the MaxOut Savings Advisors, we're not going public, but we're like the only one in the United States not going public right now. So where is all the money going to come from this? And that is the real key issue that we're dealing with in these markets right now. Is SpaceX is coming out $1.8 trillion market cap. I mean, if you look at these others, they're huge numbers that they're going to spend. In addition, you've got all these companies spending money. And so where's all the money going to come from to fight the war in Iran, to fund a $2 trillion deficit, to spend about maybe $850 billion this year? I'm skipping over and probably 1.3 trillion next year for AI. Where's all the money going to come from? And that doesn't include the build out of all the factories that President Trump has gotten brought back into the United States. And so this is the issue. And so everybody is scrambling for money. This is what we've been talking about on the show here for a month or so, is where's the money going to come from? And all of a sudden it's dawning on people, oh my God, if all these companies come public, I thought maybe SpaceX, and then sometime late this year, next, Anthropic and OpenAI and Databricks and Stripes and the rest of them are going to come out. And all of a sudden, everybody's rushing to the door right now because the valuations are so good. Well, if they want to buy the stock, they're going to have to sell the stock. So it's like if you look at portfolio managers, they have record low amounts of cash on the books. So if they buy the SpaceX deal, if they buy $50 million worth of the SpaceX deal, or, quite frankly, I mean, honestly, we buy a couple, $2-3 million worth of stuff at a time. These people are buying, billions of dollars at a time. Where's that money going to come from? And so they have to sell something else. They have to sell Microsoft. They have to sell Google. They have to sell Amazon, Apple, and all these other things. And that's starting to weigh on these companies. At the same time, the companies are having to scale back their buybacks because they're raising so much capital. They're spending so much on AI out there. And I think this rush for companies to raise cash is putting a top on the market. Let's take a quick call from Charles. Charles, you there? Again, this is live here today. We're making the transition to video now, so it's a little bit tough. Why don't we just type Charles's question in and we'll get it answered for him on the air here. So that's what so this is a big story out there right now that most people look. Markets go up because of money. They rise and they fall on money. And so if earnings go up, people say, hey, we might make some money here. Let's put some money into it. Or if money markets are yielding 3 or 4% and they suddenly go to zero, it's like, I'm getting zero. Let's just put it in the market. I'm not making any money here. So or there's other things up here. And the other thing we've talked about all year long is distribution, where we're really seeing distribution come into the market were big institutional, and I think this started back in September of last year, it seems like some really big money has been selling into this market. I think the really big money is starting to sell into this market in the last week or so. I think they see these new issues. I think they're looking at this and they're realizing that this is kind of a big issue, and so the question is, where's all the money going to come from? And you started to see the selling really kick in this week, and that's why. And it finally caught up to the market here on Friday. And so I think we have to kind of watch and see what's going to happen. Now, here's a question right here. This is a question. Okay, well, this is helpful. I just actually, evidently, I'm the only one that can't hear Charles, so we're going to try to work on that over the break. Okay, here's a question. What do you think about Jamie Dimon buying the credit division of Blackstone? Yeah, I mean, oops. I've heard some rumors of that. I don't think it's out there completely yet. I think Blackstone and some of these other companies kind of would like to get into more of the build out of AI. They would like to get into the build out also of not just data centers, but also the electricity production and the different things like that. And I think the credit sector is really under pressure, because keep in mind, what's this month? It's June. What happens at the end of June? That's the end of the quarter. So if people want, if out of private equity right now, they're letting their people know, they're calling up the company and saying, get me out. And so these private debt company, private credit companies are all under huge pressure because everybody wants to get out of their programs. And so this is another reason why the private credit crisis is tightening money. This is raising the cost of money, which is forcing more of the big tech companies to go to the equity market to raise more cash, because private credit has gotten so expensive. So this is a really good question actually on Jamie Dimon of JP Morgan wanting to buy a division of the credit division of Blackstone. And on Jamie Dimon's side, look, we talked about this on the show a couple weeks ago, is if you look at the balance sheet of the big Wall Street banks, it is shocking, completely shocking how little of that balance sheet is loans. A lot of it is repos, reverse repos. It's treasuries, it's security, it's securities lending. It's all types of stuff going on lending to hedge funds. It's not lending to businesses. I mean, it's the number. It's for JP Morgan, it's like 15%, or it's absurd. And so if they can go buy this division of this private credit, that gets them into the lending of, hey, we have loans, we're supporting the U.S. economy, we're supporting manufacturing and new factories and jobs, because what they've done, the big Wall Street firms are making a fortune lending to hedge funds. These hedge funds are coming trotting over to JP Morgan and other places. They're giving them $10 billion worth of treasuries and getting $50 billion worth of money to spend during trading during the day, and then they close the positions out later in the day, and that's how they're making a lot of their money. That's not in the best interest of the United States or the American people. And one of the things that, and again, this thing with Kevin Ward, there's big changes coming at the Fed, and the Fed is like, look, guys, we want you into lending money. So when we inject money into the economic system, into the banking system, it doesn't go zooming over to Wall Street, making the top 10% of the people in the country more wealthy, and then the bottom 10% are suffering. We want, when we inject the money, you call up Ted and from JP Morgan and said, hey, the Fed's looser, we're loosening our standards. Ted, would you like to build that factory, to build new cowboy hats or something in Texas? And so this is one of the changes. So that's an interesting question. That there are two things. I think Blackstone would like to get more into investing in, where they're going to put equity into building a power plant and do it that way. And JP Morgan they really want to be, hey, we're lending to power plants, we're lending to companies, we're creating jobs that they're not doing right now. And this is all about reserves at banks. How are they defined? And this is incredibly, I cannot tell you how much money we spend talking to people on research in this area, because I think it's so key. And but there's bigger changes coming. Good question on that. We had another question coming in on SpaceX. We have a lot of interest in SpaceX. We're not participating. Most of the big firms are participating. If you'd like to get into SpaceX, you call up your broker, Fidelity, Schwab. They have actually, we did something for an endowment. I'm on the board on this week. We wanted to get some Tesla, some SpaceX, and it was relatively easy to get to put in for the SpaceX. Now you can put in on like $10,000 worth or whatever. That doesn't guarantee you're going to get it. It's an indication of interest. I'm stepping up for 10,000. They might only give you 5,000. They might give you 10,000. But one thing that SpaceX has done is they have come in and they've tried to push more of it into the retail environment. I mean, people forget SpaceX has been, quote, private, but they went public on one of these private capital raise platforms where individuals got to invest. There's a lot of people going to get rich investing in it. A lot of small people have gotten very rich because of this. So they're trying to do it that way. That's the situation. Like I said, it has a very high valuation, which I'm not real sure it's the best deal. And I'm really uncomfortable buying things in this type of frothy market on IPOs. As we were talking about a little earlier in the show, there's an enormous number of companies. Meta just came out. Meta put the top in on the market. I think when there's rumors out that they're going to raise cash, I think they might have put the whole top, because people are like, oh my God, everybody's going to come in wanting to sell stock now. How does this market go up at all? Because remember, if somebody wants to go, I'm going to participate in the Meta offering, well, they might go sell some of their Google, Microsoft, Amazon, or Apple to fund it, because there's not a lot of cash sitting around Wall Street and sitting around in investors' accounts, because they're all in the market making a fortune right now. They're in whatever company that's going to go up 30% tomorrow. And so that's not a good situation overall. So this is a big story coming up with a lot of IPOs coming out. With the SpaceX is likely to be priced next. Is priced at 135. It's going to come out next week, and we'll see how things react. One of the things that was really not good and what really spooked me on this market here, and one of the reasons, like I said, we put a hedge on, was the Quantinuum deal came out, which was supposedly the best quantum computing company out there. It came out at $60, zoomed up to 71, and then it closed later in the day closer to 60, and then Friday it sold off around 56. That is not a good sign for what was supposedly a hot IPO to basically sell down in the market immediately, a big one. That tells you that the pricing isn't right. That tells you there's way too much froth in this market, and I think you got to be careful in here. And so let's take a quick break. We're going to also discuss, we had another question on interest rates. How do we lower those? We'll touch on those on the next after the next segment of the MaxOut Savings Show.
Ted Geoca and the MaxOut Savings Show continue after this short break. To find out more about MaxOut Savings Advisors, visit MaxOutSavings.com. In a moment, more of the MaxOut Savings Show.
The Big 1070.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
I'm Ted Geoca, and I approve this message.
Inflation, instability of the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues, and that's where Ted Geoca can come in, and he can help. Go to MaxOutSavings.com and schedule some time with Ted. That's MaxOutSavings.com. And listen to the Max Out Savings Show every Saturday at 10 a.m. on AM 1070 and FM 103.3, The Answer.
And now, more of the Max Out Savings Show with Ted Geoca.
Welcome back to the Max Out Savings Show. And talking savings investments in your retirement. Just check something here. We had a question come in on one of the questions we had was, how do we lower rates in this high interest rate environment? Look, I think how it sort of is going to happen is a couple things. On the longer end, I think they're going to do something called yield curve control, which simply means they're going to try to push down the long end to keep it from getting too high in because that spooks investors. And so this is why the market went up to, like, I think 510 or something like that on the interest rates Friday, but then at the end of the day, it went down to 4.99. So it was under 5. And I think that's the thing. And the other thing you're going to see is when the market has a big sell-off, that's when it's going to let them put interest rates down. Look, the Fed cannot cut rates when you have a stock market going completely crazy. I mean, yet when you got inflation going up, when you got employment going down, it just makes it real. I think you could actually push them down some, but when you got a market as hot as this, it's just because there's just too much danger. The whole thing just has a massive blow off top, and it just makes it very, very difficult. And so I think it's going to take a drop in the market before they can start saying, hey, maybe we need to cut rates. And the reason, look, as we talked about, President Trump has a very good plan. He's been pretty much, I don't think people realize how good a plan he had it was sidetracked by the Iran war, but the idea of what we're going to do is we're going to put tariffs in place. We're going to collect $200 or $300 billion a year, reduce the deficit. Then they're going to come back and build factories back in the U.S., which is going to increase the economy, which brings in more tax revenue, and that's going to be a good thing. And then what we're going to do is we're also going to push down the interest rates so we pay less money on our $38 trillion deficit. That'll further reduce the deficit. And so it's all going to add up. We got more tax income coming in. We're going to reduce government spending, and all of that should start working the debt. People will get more confident and rates will go lower. It was a brilliant plan that they put in place. It's just the war in Iran went badly, and oil went to 100, and then it's taken a lot longer than we thought, and that's kind of gummed up the whole system. And again, I mean, this idea back and forth. I mean, Trump, look, one of the most brilliant things I've ever seen anybody do has been what President Trump and the set did when whatever their plan was. They realized that there's a real danger of oil spiking to 150 real easily. And they made it seem like this war was ending next week. I mean, how many people listening assume we're going to hear something about a great deal with Iran sometime at, 6 or 7:30 Monday morning before the market opens up? I mean, he's been remarkable about that. But if you're trading crude oil, and you're trying to buy a tanker full of crude oil, and you think it's going to 150 because there's a shortage, and all your research tells you that. But then you look and you're like, Trump might come up with something. What am I get? Then I'll get blown up and lose $20 million. And so he has very effectively and just brilliantly done is he has forced the speculators out of the market. He's scared them out of the market, and it's kept oil prices from really going up. I mean, if you listen to what the head of Exxon and Chevron said, look, if we don't get this thing over pretty quick, oil's going up because, I think Japan's gone through 25% of their reserves, and the United States has dropped ours substantially out of the Strategic Petroleum Reserve. And China's done a little better because they've hidden what their reserves are, but we're starting to run out. And so this is something we're going to see. I mean, one interesting thing here is, to change subject just a little bit, but where is it? The dollar is up here, and so what's going on? If you look at the U.S. dollar, it's at 100. The Dixie's at 100, and it back in February it was down around 85 or so. Was it? About 95, so it's going up. Well, you go, well, hey, we've got all this deficit. What's the problem? We're losing money. We got $2 trillion budget deficit. The U.S. is in trouble. Why is the dollar going up? A couple things. Interest rates are going up some, but the important thing is we're exporting about 2 million barrels a day of oil, and that does, and probably a good chunk of condensates, which are diesel, gasoline, and jet fuel, out of the country. So if it's just 2 billion, that's $200 million a day that people have to be buying. It's probably more than that. They have to buy more dollars because it's like, yeah, I've got your oil tanker here. When do you want to put it up? Just send me the what is it? If it's a million barrel, send me the $100 million. Well, I've got to go convert my yen into dollars or my euros into dollars to go get it. And that's one of the things that is kind of really keeping up the dollar in here, which is very interesting. I mean, our budget, our export deficit is falling because we're exporting so much oil and gas and diesel fuel out of the country here. So again, a lot of I've thrown a lot of stuff at you here today, a lot of moving parts, but a couple things I want you to understand is these new issues, these IPO, initial public offerings, and secondaries. Initial public offering is a new company coming onto the market, like SpaceX next week, $1.8 trillion. I can't believe I said that correctly. I struggle because I still don't really know what $1 trillion is. But most of my stuff in engineering, we never got to $1 trillion at A&M. It's just back in the day. But there was no trillion pounds, no trillion kilonewtons, or it just wasn't there. And so, but so big numbers, or the secondary, like Google's $85 billion secondary, they're putting what's known as supply on the market. And what that is, that's simply stock that needs to be sold. And then so someone has to sell it. And as I said, and kind of repeating myself, but this is an important concept here, is someone else, if you want to buy something, you got to sell something else. Maybe you go down to the bank or use your money fund, at the firm or the cash account. But if you don't, then you got to go look and see, hey, what do we have? What else can we sell? By the way, this is one of the reasons we like a lot of cash right now. We've been raising cash. We put a hedge on Friday for our clients, but we had cash to do it. But the nice thing about cash is when things are really hot, if you don't have any cash, you can't buy things, then it probably not hurt. But when things are down and really cheap, that's when you want to have cash, because it's one thing is, hey, I'd like to be in that Tesla IPO. I need $1 million to put into it. Where am I going to get my $1 million? So I look around, and maybe I'll sell some Apple, sell some Amazon, right? Well, the prices are pretty high. So yeah, it's kind of not a bad deal. I'm happy. Everybody's happy. Well, if I'm going to go, if I want to buy, say, Tesla's down 30% or whatever. Oh, this is such an opportunity. I'm going to go sell my Microsoft, Google, Amazon, or Apple. And then I look, and they're all way down. So then that's not such a fun situation to do. And that's why you want to have that's when you want to have your cash, is when things are cheap, because then you can take your cash and deploy it into the market and make good money, and you're not selling out something. Oh, I wish I'd have never sold my Microsoft at such a low level to buy the Tesla. Yeah, Tesla's up, but I lost, I gave up so much money with Microsoft. And so this is why we talk so much about cash. Cash is an opportunity. It's huge opportunity cost when things are bad. When no one else has cash and they're afraid, that's when you get your good opportunities in the market. So I do think you need to have a risk plan in place in here. When it comes to the bond market, until we get an idea of what this inflation situation is going to be, we still like the shorter term 1-2 year in fixed income. That's just our opinion. But I think somewhere in here, there might be an opportunity to invest long term if we can get something solved with the Iran war. And then I think that might, because I do believe one of the big things, as we've said on the show, is I believe we're going to see real interesting things come out of what Kevin Warsh is going to try to do. Look, Kevin Warsh is a very smart guy. Okay. He was involved with Soros way back in the day. He's been, which is not a positive, but it is a positive in the fact that George Soros really understands financial markets, and more importantly, financial systems that most people just don't understand. I cannot tell you, I've said earlier, I can't tell you how much money we spend trying to understand financial systems. And he was the master at it. Kevin worked with Stanley Druckenmiller. There's not another guy out there that does as good as Druckenmiller. I always try to listen to everything the guy is saying. He's got an incredible record. And so Kevin Warsh is a very smart guy. Now, he knows the United States has got $2 trillion. I mean, we have a $2 trillion deficit, and we have $38 trillion in debt. Now, he's not the Treasury Secretary, but he's at the Fed, so he knows he's going to have to deal with the problem that might come up. And so he's going to have some type of plan, and that's the important thing. And so as this comes out, I think that's going to create opportunities in the market. But right now, it's really all about these new issues coming in the market. We're going to have to see when SpaceX comes up. Like I said, I think I was surprised Fidelity was able to get it. I don't know if they were able to get it, but it was open on Friday to get the stock. They're still doing a road show. And so if you want to do something, you have to do it quickly. At MaxOut Savings Advisors, we hold our clients' assets, the custodian at Charles Schwab. And we haven't checked with Schwab. It's just because some of the groups I work with, I'm on the board of, I just happen to know that about Fidelity. But that's and again, the Quantinium deal coming out, and I understand this is very complex and a lot in the weeds, but this was the best quantum computing company out there, and it came public. It gapped up and then went down. That's not a good sign. And I don't think I'm not convinced the valuations are just out of control. I think what's happening, well, to some extent, that's it. I just think there's such demand for money for these companies. As we talked about, all these big tech companies, they were basically quasi-monopolies with a moat around them that were buying back stock, had huge cash hoards. These are the numbers. I think it's Amazon is going to have to spend $200 billion this year on AI. Microsoft, $190 billion. $190 billion from Google. On Meta, $140 billion. These are the numbers that they're spending huge amounts, and you're starting to see this. Everything isn't what they thought it was going to be with AI. This is getting so expensive that they're going to have to put the compute out on the system, and people are going to buy more higher end computers like at Dell and Hewlett Packard. They're going to have systems that can do a lot of the AI themselves because it's so expensive. One of the big companies rumored to be Amazon, this big story, they came out, they're like, hey, we want everyone on AI. We're having a little board to see who can do the most AI. They spent $500 $500 million in 1 month. They had to say, whoa, we need to slow down. I mean, this is people are realizing this stuff is very, very, very expensive. And so there's a lot of, and the other thing, NVIDIA is selling a ton of chips. Well, if they can't get the chips into the data centers, that could slow things down as well. The wheels are kind of coming off the AI nirvana bandwagon in here there's cracks coming all over the place. And I really think this is putting some type of top on the markets. So again, exciting. We're doing video. We're starting to do video. It'll be up on the station. And so you'll be able to get it there. It's going to be on YouTube here sometime this week. We're hoping to get that going. So a lot of stuff happening. Oil is coming down some. Oil is about 92 or so on the Brent. Well, I mean, the problem is, if you really look at this Iran situation, it's pretty bad. I mean, even if the Iranians agree Monday morning, it's going to take months to get this all straightened out. And in some of these countries are running out of oil and gas. And right now it's being really funded by inventory, by stockpiles. And those stockpiles are running down. At some point in time, they have to close. If you look like the U.S., a lot of it's salt domes. Well, we might have how much oil we have. Oh yeah, I've got 50 million barrels sitting in my stockpile over in the salt dome. Well, those salt domes, they can't take it down to zero. Because the salt dome could start collapsing. It's kind of a complex thing, and so you've got to be much more careful on those. It particularly places like Indonesia, Philippines, Suriname, Vietnam, Thailand. They're very, very short on oil and gas. India, this is a real problem. It's slowing the economy down. So again, a lot of issues out there. A lot of problems, rising rates, rising inflation, oil prices, dwindling stockpiles, AI spending's out of control. And now every company on Wall Street is trying to raise cash. This group of things does not correlate with the stock market being at record highs in Tuesday. So I'd be a little careful in the market. We're going to be writing about this in the MaxOut Savings Report, which is a free report we send out once a month. Just go to MaxOutSavings.com, sign up for. Look, if you need help with your retirement, you're retiring, you have an old retirement plan, or you're not happy where you are, give us a call at MaxOut Savings Advisors. We're value investors in the stock and bond market. We hold our assets at Charles Schwab, and we simply manage them for you. So if you need some help, go to our website, get the phone number, or drop us an email. We'll set up a free appointment here in Houston, Texas. This is where our offices are. It's MaxOutSavings.com, MaxOutSavings.com. Until then, remember our motto and philosophy, which is to save aggressively, invest conservatively. That should be your motto and philosophy too. Take charge of your retirement today. We'll see you next week right here on the MaxOut Savings Show.
This has been the MaxOut Savings Show with Ted Geoca, a presentation of MaxOut Savings Advisors. Join us next Saturday at 10 a.m. for the MaxOut Savings Show with Ted Geoca on AM 1070. The Answer.